Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of young entrepreneur Chrish Salerno from QC Capital. Chris, welcome to the show.
Thank you so much for having me. Very excited to add value to all your listeners and super excited to reconnect with you.
Absolutely. So Chris is based in Charlotte, and as young as he is a bunch of energy and high aims, and that's what I love about young entrepreneurs.
Thank you.
And today they are on a brink of starting a $350 million fund. Currently, they own $40 million worth of assets in Greenville, South Carolina, and you said Texas as well?
Charlotte. Yep.
Charlotte. Okay.
Mm-hmm.
And he is on to a lot of big things and good partnerships. So today we are going to, dig into his story. So for listeners, Chris, give us some background as to, how you got started and sort of why real estate is a passion of yours.
Yeah. Well, thank you again for having me. Super excited. I love what you do. And when I first got started in the multifamily business, I listened to podcasts just like yours to gain knowledge and to understand from, firsthand people who are operators, passive investors, what they're doing, what they're seeing, what questions to ask. So thank you for what you're doing by providing just tremendous value to all your listeners and your audience. So I definitely thank you for that. Yeah. So originally I'm from South Florida, Fort Lauderdale. Love it down there in South Florida. I've always had a passion for real estate. I remember as a little kid, I'd sneak under a gate to a very luxury community and ride my bike through the community. And just, I would see the design of each home and it was always different. And I love
Absolutely.
that.
Yep. Absolutely.
You're rarely going to see the same house over and over. Rarely. Now, when you get into these new cookie cutter neighborhoods, they all look somewhat similar, but the outside could be different and inside could have the same layout, but the people who live there are going to design it differently. So I just had a passion for it. My father's been a real estate broker for about 54 years in the state of Florida. Wow. So at a very young age, he'd take me to work with him and I would just sit there and listen. I'd listen to older gentlemen talk business. He's 80 now. So I was always around older gentlemen, 60, 70, 80 years old. So I'd just listen, hear them talk real estate. And I was always intrigued. So coming up, moved up to Charlotte, North Carolina, been here over 13 years. I went to Winthrop University for a year and a half, ran Division I track there. Getting out of college, I realized college is the best business there is because that's the only loan you cannot file for bankruptcy. So I realized that very quickly. So I left and I got in. I worked 2 jobs at the time, but I was always thinking about real estate once I got out. So I said, I'm going to pursue brokerage. I'm going to sell residential real estate. The reason why is because I knew my work ethic. And when you're in any type of position that's 100% commission, I would never want a salaried position in my life. I don't want to be paid hourly ever in my life. I want to be paid 100% commission. The reason why is because I know I will outwork my competition. No matter what it is, I will figure it out very quickly and I will outwork my competition. And that's brokeraging real estate. So I said, I'm going to get my license. So I was working 2 jobs at the time, got my real estate license. I had, I think like $4,000 to $5,000 saved up. And I was in my late teens, early 20s. And I said, I'm putting my 2 weeks notice in at both jobs, put my 2 weeks notice in. And I then saw my bank account and I knew what I needed to do. And I said, I'm going to make it work. Went out there. I made phone calls. I did over 72 open houses my first year. And then from there, I started scaling the business. So very quickly started selling a lot of houses. Over the time of me selling, I've sold over 150 homes just within 3 years, a little over 40 million in volume. My last year, I think I sold like 75 homes just my last year of brokeraging real estate. I ended up from there creating a small team, but merging that team with the number one team in the Carolinas. And I was their top agent. I trained all their sales agents that came on board after I came on board. And I started training and doing small seminars in sales here in Charlotte and training other agents in the United States. And very quickly, I went back to an old game, which we all played, called Monopoly. And I realized you don't broker real estate in Monopoly. No, the game to win Monopoly is to build wealth by acquiring all the assets and getting paid rent passively.
Sure.
So I said, I'm in the wrong business. I started studying between 2008 and 2012 what asset class was the strongest and what recovered the quickest.
Sure.
It was multifamily.
Correct.
I said, this is the asset class I'm going to be an expert in. I then started listening to podcasts like yours, like mine, hanging out on YouTube, understanding what the lingo is, what's this verbiage, what's IRR, what's cash on cash, how do you calculate it?
Sure.
What's a cap rate? How do you calculate a cap rate? Studying all that, I came across my current coach, his podcast, Never Knew He Coached. I actually ran in to someone at funny stories. I ran into someone at a meetup. I dressed in a 3-piece suit because I'm thinking I'm walking into like a Blackstone's executive meeting. Sure. We're going to talk real estate. And I walk in and everyone's in flip-flops and a t-shirt. And I said, am I in the right place? I'm here for the multifamily meetup. They're like, no, you're right. You're in the right place. I said, okay. And I always recommend a good nugget to take for your listeners is that if you go to a conference or go to a meetup, you can take your spouse to a conference, but let her or let your spouse hang out in the hotel, bring your kids, let them go to the pool, but go to the conference by yourself. The reason why is because you'll be willing to talk to people. Then if you had a friend or had your spouse with you, you'll just talk to them all the time. So you're really not going to make as many connections as if you would just go by yourself.
Sure.
So that's what I do now. But I went there by myself, found out he coached, got a call with him. I then joined his program and started scaling the business very quickly, syndication style to a little over 40 million and 364 units. And then now now we are in the process of creating a large fund. So that's a little background story myself.
That's awesome. And I always love, Chrish, that folks who basically had, a few things like, for example, you check a lot of great boxes wherein you had a strong real estate family background. Like, there's nothing like, your dad supporting you or as you're growing up, you're listening to all the different stories that come along with this business, right? And then I think the fact you mentioned about you also did sales, and that's real estate sales. That is such a big dynamo right there, is that you learn the market, you learn how transactions are done, what issues can occur, setting expectations and things like that. There's just so much that goes on in the sales that I love. And also just the whole brokerage concept is that what it takes to close the deals, what's important for buyers, and what are some of the nuances of closing that deal. I love that. So moving on, Chrish, why do you focus or like so much so about the multifamily? Like, why not continue perhaps what you were doing and maybe going to flipping houses perhaps, or holding some rentals for that matter? I mean, why multifamily, if I may ask?
I love that. So I did flip houses, flipped about 3 houses, and I do have 1 single family rental. The only reason why, I have a big heart, the only reason why I'm keeping that rental is because the tenant really wants me to be their landlord, and that it's cash flowing like $600-700 a month. Sure. So I'm not gonna pass that up, Sure. So, and the maintenance is very low on it, knock on wood. So during my transition of leaving brokeraging, and I do not brokerage real estate anymore, I let my licensing go. But during that transition, I did some flips, and I have that 1 rental. And I realized that flips, it's a lot of work. I had a contractor steal $90,000 from me.
Wow.
And I'm not going to get it back. And the thing is it's not like I picked him off of a website. He's done work for me previously.
Wow.
And this was our third or fourth deal or flip that we've done together. And for some reason, he just had a change of mind and decided to take my money and run.
Wow.
So I learned a lesson very quickly, and I learned very quickly from mistakes. So when it came to that, I realized, so much time. It took two properties took 1 year to renovate. I mean, outrageous.
Wow.
And even if you had a good flip and you have a good team, which I know flippers that do over 100 flips a year. They love it. They have a system, they have their business, they have the people in place. That's good for them. You're only going to profit a certain amount.
Sure.
Yeah, you may make $1 million, 1.5 million. Totally different. When you get into the multifamily space, you're going to make a lot more money. And not only that, when it comes to COVID-19, for example, when it comes to flipping, or when it comes to single family residence, for example, flipping, you may be, COVID-19 took about 6 months total. It will, it may take even longer to complete that flip and to sell that flip. So when it comes to that, it's very important to keep that in mind. When it comes to a single family rental, I've learned very quickly, if you're renting from me and you decide not to pay the rent, what happens? I have to pay it.
Sure.
If something goes wrong, I have to pay it. So my margins of profit go very, very low very quickly.
Sure.
And depending on what state you're in the state of South Carolina, you're taxed at 6% compared to 4%. If you lived in the property, you'd be taxed at 4%. That extra 2% makes a big difference on your profit.
Sure.
But when it comes to when I started studying multifamily, I realized one roof, 50 people under it. If 5 people don't pay, who makes the payment? The 45 other people.
Sure.
If a hot water heater goes out in one unit, who pays for it? The 50 people in there. So I realized that very quickly, and I said, the economies of scale just makes sense when it comes to multifamily. This is the asset class. Plus, one thing I want to touch on is that retail was already in a recession before COVID. What put retail in a recession? Amazon, e-commerce. You will not create an Amazon to take out multifamily. You just can't. Why? It's a necessity. We need shelter. And for me, I mean, I would prefer to live in an apartment complex. My fiance doesn't. So, you always got to have a balance. But there's an apartment complex adjacent to our neighborhood, and it has a golf simulator inside. It has a putt-putt range inside. It has a masseuse table inside where they have a masseuse come Monday through Friday that you can book.
Interesting.
I mean, who would not want that?
Absolutely.
I mean, I would love to have that. Yes.
Sure.
So when it comes to that really sets it apart, and having the amenities, the gym, the Starbucks coffee. Okay. You don't have to pay $10 for coffee anymore. You can go ahead and just go down to your lobby, take Starbucks, and go on the road. So it's that right there that, it's going to be very hard to create an Amazon. Well, you can't create an Amazon because it's a necessity. But as owners and operators, we're always thinking of different ways to better the amenities and attract more people to the apartment complex.
Absolutely. Very, very well said. Very well said. And I'll share with you also, Chrish, is that some of my experiences also is like I own a significant amount of single family portfolio as well. I mean, knock on wood, we did great renovations, very low maintenance and stuff. But one of the hardest things sometimes I find also is that single family world, because you're always operating on, or selling off of the comparable markets, you can have the greatest house in the neighborhood, but it's so tough to sell on CMAs, as we call it.
Oh my goodness.
Whereas in multifamily, boy, I mean, you are rewarded for increasing your NOI so nicely,
Just even $50 times 200 units.
Sure.
I mean, that's a couple million in your pocket.
Absolutely. And that is such a huge difference in my eyes that, I mean, when I saw all this, I was like, oh my God, this is the game I need to be in as well, because I was like so much, into single family and knowing all of these things.
I know.
But coming from a different perspective, I was like, oh, you know what? It makes complete sense. And that also definitely excited me, other than some of the things that definitely you said,
And when I did that math too, I had to do it a couple times. I had to ask people, are you sure? Like, you actually make that? And they're like, yeah. And then on top of that, the tax benefits. I'm
Sure.
like, why? I mean, why would people not want to be in this asset class?
Absolutely, absolutely. Now, Chris, talking about markets and submarkets, right?
Mhm.
What is your philosophy about evaluating the submarkets and sort of targeting to purchase the multifamily assets? How do you think about that?
Yeah. Well, to speak for our group, we focus on very large cities. So Raleigh, North Carolina, Charlotte, Charleston, Greenville, South Carolina, and we will look into Wilmington. Those are the really major 4 cities. Oh, also the Durham area. Those are really the major 5 cities in the Carolinas. And when we evaluate assets, we evaluate location. We evaluate how accessible it is to the main road, to the highway, to jobs. One thing we really look for, and my underwriters get back to me once they underwrite it. We have an analyst that does a full comp study. He will call each asset if it's not local. He'll call each asset, do a full background on what they're offering, all their amenities, if they're upgraded units, if they're not. He'll do a crime statistics report for us, and then he'll give those comps to our underwriter, which our underwriter will underwrite. But the main thing that I love is that we will look for a Starbucks and a Chick-fil-A.
Interesting.
And if you look, Starbucks and Chick-fil-A are normally very similar to each other in a vicinity.
Sure.
The reason why is because they do a large study on demographics, because who's going to pay $5 to $10 for a cup of coffee?
Sure.
So they're only going to put that Starbucks in a certain location that people are willing to pay $5 to $10 for a cup of coffee.
Sure.
So if an apartment complex is very close to those two, large chain, we will, that's a perk. Now, if it's not a deal breaker for us, but that's just the icing on the cake when we see that this apartment complex is very close to one of those large type of franchises.
I see. And what about some of the other factors, like let's say the neighborhood density, or how big the sort of the roads are,
Yeah.
or how good the neighborhoods are and things like that. Do you kind of maybe, these are some of those subjective things I like to say.
No.
Do you consider some of those factors as well?
We take that in full consideration when our when our analyst starts analyzing an asset, or going ahead and starts to do their underwriting on an asset. He will call the city. He will ask the city, what plans are going on in that area, what permits have been pulled, what type of permits have been pulled. Are we knowing that the roads are going to be wider, or they're going to be office buildings, or they're going to be shopping centers? Okay, with those shopping centers, have there been any business permits for grocery stores or gyms? Because all that plays into a factor. So we dig really deep into it. I know here in Charlotte, they're now putting in the South Charlotte area tolls. I know North Charlotte, they put tolls up there. So we like to play that into a factor. Okay, well, if the city thinks there's tolls in the area, obviously that's a great area to be in, because people are willing to pay for a toll, which I am, because you save a lot of time just for a couple cents of driving on the road in that area. So we play all that into a factor when analyzing one particular asset, to ensure that we even want to move forward with a showing of the asset. If it doesn't meet those criterias, and we do have more criterias, if it doesn't meet our criteria, we won't even schedule a viewing or a showing of the asset.
Sure. Now, speaking of the submarket there, Chris, right? How do you go about just understanding the business landscape as to what companies are moving, or what the growth projections are and things like that? Do you mostly solely rely on some of the reports that we typically see, or some of the news data that you come along? Can you maybe share some tidbits about that, as to what goes into researching deep into a submarket, for example?
Yeah, I love that question. And, I don't solely rely on the reports. The reports are great, but the reports can also be like the news. Whatever they want to tell you, they're going to tell you.
Sure.
So, and when it comes to the brokerage companies, I have not seen at any of these reports when it comes to Newmark, Marcus, Cushman, anything bad about a city. They only post everything good about the city.
Sure.
So because they want to sell you on the city. So when it comes to it, we don't solely rely on it. We do like to see it. We do like to know what's going on. I study the stock market too. I don't invest in the stock market, but I study it so I know what's going on because it can affect us as operators. So when it comes to analyzing a market, one thing I like to do, and I had a background in brokerage, residential brokerage.
Sure.
I like to, the good thing is I built great relationships in the Carolinas with brokers and in Texas with residential brokers in the major cities, but I like to reach out to them. Where are you seeing people move? Where are you seeing people deciding to rent? Where are you seeing new construction happening for homes? Where are you seeing the fluctuation of the population moving? What area would you sell a house compared to another area that you would not sell a house? Because they're kind of like the army. Don't correct me on this, but when it comes to the army, I believe the army is the first one that's boots on the ground when they send the troops out into a war. And that's what a real estate agent is. They listen firsthand from people. Oh, you're leaving this area to move to this area. Why? Okay, is it jobs? Is it, is you just don't like that area? So it's good to go down and to ask them, what are you seeing? Ask the top agent. Don't ask a guy or a girl who's selling one house a year. You got to ask someone who's selling over 100 homes a year. Where are you seeing people move to? Why are they moving? I have an apartment complex in this area. What do you think about this area? And that will help you tremendously.
Great tip there. Now, Chrish, speaking about just the asset class in general, whether how do you acquire? Like, are you focused on Class C assets, Class B assets? Can you maybe share some tips about why you like a certain asset class to focus on?
Yeah, definitely. I always believe, gaining experience and gaining knowledge is key. So I've purchased a C plus asset prior, and know that we as a company do not want to focus on C assets because of the age. Because with the age comes a lot of maintenance, a lot of upkeep. So our main focus is B. Primarily B value add and A core plus asset. No matter what asset we like to look at or acquire, we want to find some sort of value add component.
Sure.
If it's just making, the amenities, updating the amenities, if it's owning the Wi-Fi and adding Wi-Fi in each unit, some sort of value add play we definitely want to do. So that definitely plays into a factor.
Sure. Now, speaking of C class assets, Chrish, a lot of times, sometimes the guests have shared with me that it is sometimes easier to do, sort of amenity upgrades and things like that on C class assets, wherein you can do your value add play and you can, bump the rents a lot easily. What is your take on that? Is it easier to do on a C class asset versus a B asset? I mean, what sort of things we can look into it for that?
I assume with them increasing the rents at such a large number that C class assets has to be in a B or an A class area.
Sure.
If you have a C class asset in a C area, you're not going to be able to get much rent bumps.
Sure.
So when it comes to it, if we analyze a deal and the deal by age is a C type of deal, but we know, or it isn't a B or an A area, or we know that area is transitioning because we have a lot of market knowledge in all of the select cities that we have, we will take a look at it. But when it comes to it, you really got to watch out when it comes to the piping, when it comes, to the wiring in the building. You may have to pay higher insurance.
Sure.
You're going to have to budget in your CapEx per unit to fix all those issues. So that definitely plays into a factor. But we will look at it, but we more than likely will pass. We stay strict to our criteria, and you have to. It's hard. You can't really be all over the place. So you have to really stay strict to your criteria. And it's good too, because when you tell brokers, hey, when I first got in the business, brokers send everything, and you want everything at first, but then when you start staying strict to your criteria, I email the brokers back, sorry, we're staying strict to our criteria. This is our criteria. We will not move from it.
Sure.
And then they start to see some level of respect for you. They see that you're serious. They see that they can take you seriously, and you can close, you have a good chance of closing the deal. So they feel more comfortable working with you.
Awesome. And that's a great point about, like the age of the building and some of the mechanicals that come with that, right? And the higher insurance that you can play, and how that will sort of factor it into your underwriting, that you have to budget for all those repairs and perhaps some replacements and so on. So sometimes, what you see on the surface may really not be that. And you could have an expensive lesson where, you're repairing a lot of things and not just seeing any upside at all, so.
No, yeah.
Good. Now, Chrish, how did your first deal came about? Like, how much of time, how much of research you needed? Can you maybe share some details around that?
Yeah, great question. So I'm all about broker relations, as I used to be a broker, all about building relationships with broker. They are key to the business. Yeah, you'll be able to negotiate maybe one deal or a handful of deals directly to the seller, but a broker will always be there because they're the middleman. They're basically the therapist, I say, when it comes to it. So there was an asset that came about. It was a 91 unit asset. And when that came about, I contacted the broker. We underwrote it, contacted the broker, or at that time I didn't have a team, so I underwrote it myself. Contacted the broker. We were selecting a tour. And after walking the premises, I asked him, I said, there's an adjacent property. Is that available? Is that the whole thing? He says, no, it's a separate owner. I said, well, that's 135 units. I could just go ahead and knock down that fence and create a driveway, and now I can combine them. They can use their amenities here. I said, can you find out if the owner wants to sell? He says, I'll get back to you. A couple of days later, he got back to me. He says, they'll want to sell. I said, wonderful. I want it all. So I submitted an LOI on the whole portfolio. And the seller of the 91 units actually lives here in Gastonia, which is a sub-market to Charlotte. Large seller. They have over 7,000 units. I know them very, very well. We're great friends. We hang out together. We have coffee together. And because I was newer in the business at that time, they awarded the deal to best and final to another group. But the other group did pay a lot more. So that wasn't just the factor, because I had a great sponsorship team behind me. The other group was willing to pay a lot more, which I was not. So about a couple days later, I called the broker back and I said, by chance, did that buyer get the adjacent property? He said, no. I said, well, do they still want to sell? And he said, yeah. The buyer didn't know anything about the adjacent property. So I said, okay, well, let's talk about it. So we toured the asset. It was a smaller asset, and all the units were the exact same, 2-bedroom, 2-bathroom, which I liked a lot. We ended up submitting an LOI on it. Throughout the process, it was a little rocky, had a grease fire. We were able to get all brand new roofs on the asset. And then we were able to close the asset. And then a couple weeks later, I connected with the seller of the 91 unit. His name's John Azar, and we connected. We laughed. We had a good time. So I always bust his chops now when we talk in person. I'm like, you should have accepted my LOI, but he got more money, so it's good for him. And we're best friends now. So
I know John as well, actually.
Yeah, he's a great guy. We always grab coffee and we hang out a lot. We have lunch, and I like him.
Awesome. So have you done any value add improvements at your, how are the operations going right now?
Yeah, so great question. We've done value add improvements for that particular asset. It's going phenomenal. Paused everything because of COVID a little bit, but we're back at it when it comes to it. You have to switch. We actually ended up switching property management companies, so we did that transition of did a transition of switching property management companies to more of a hands-on, aggressive type of property management company, which we like a lot. So it's going great.
Awesome. What were some of the challenges, Chris? Because a lot of times, typically no response or lack of reporting, and there's some issues that play into when you change the property management. And I always like to dig into some of the issues because a lot of times investors do not realize that what some of the proactive actions they have to take. That, I mean, as we all know, that things can quickly spiral out of control, and next thing you know is, boy, I mean, you have from 3 units vacant, you suddenly have 7 units vacant, and they are not renovating or not advertising correctly and things like that. Can you share what some of the problems you have had with your property management?
Yeah. So, one of the big problems that I see across the board too, not just with our situation, but across the board, is that you got to watch, on smaller properties when you don't have an on-site maintenance and you're going to third party, all the maintenance requests or anything like that, is that, you don't want the property management company to own that company as well.
Mhm.
And the reason why is because they're going to upcharge you. They're going to upcharge you on every little thing you do. For
Sure.
example, there was a situation for example, a situation that came across where there was a fence that needed to be addressed, and the company wanted to replace the whole fence. It was like
Mhm.
a couple grand. Well, when I went out for a further inspection, there were 4 screws that needed to be in there. So I did it myself. I got a drill, a couple screws, and drilled the screws in. Now the fence is fixed. So, things like that. That also tells you want someone who's local. You want someone, and you want an operator that can be in driving distance, and that is boots on the ground because of situations like that,
Sure.
where
Mhm.
you go out there and you can say, okay, it just needs 4 screws.
Mhm.
I don't
Mhm.
need a couple grand fence. I just need 4 screws.
Sure. 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 Mhm.
So that really, that's something I definitely say keep an eye on when it comes to interviewing property management companies. Who do they
Mhm.
use for maintenance? Who are their preferred vendors? Do they have a cut in any of that profit? Because that's very important. And like you said, during the transition, you want to make sure that transition is smooth as possible. You're leaving a company, and that company is losing business, is losing money.
Sure.
So, they may be unhappy, but you just have to make sure communication is key. And at the end of the day, in my eyes, a property management company would not want to ruin a transition, because their reputation's on the line.
Sure. Mhm.
If something bad happens, if someone asks me about about a property management company that I had a bad experience with, I'm gonna let them know, because I don't want them to lose money. I don't want them to, harm the deal, harm the investors. I want that operator and those investors to make money. So, I'm gonna say, look, this is the experience I had.
Right. Right.
And then
Mhm.
whether you take it or not, it's solely up to that individual. But it's very important to make sure communication is key on that transition, because like you said, they could just let it go and you can start to get vacancies, and you may have to come out of pocket for some of the rent.
True, true. I mean, it's such a hard business, and I think knowing asset managers, sometimes the hat we play, it's very important to just always keep a tab on what's exactly is
Oh yeah.
happening at the asset. Now moving on, Chris, that your company is soon to launch a $350 million a real estate fund.
Mhm.
Can you share some details as to why a fund, and sort of what the goals and what sort of assets you're targeting with your fund right now?
Yeah. So before this, I had a call with an investor, and and she asked me the same thing, and I started digging into it, and she's like, "Wow, that's different." I said, I've read 5 to 6 books that were 400 to 600 pages. I've listened to interviews. I've spoke with fund managers, spoke with institutions. I'm like, it's totally different. So when it comes to it, it comes down to the goal. What's your goal as a company? Syndication is great. I love it. But you can only scale so much. When it comes to creating a fund, there's a lot of perks about it. A lot of benefits about a fund, and you can scale very quickly. BlackRock and Blackstone are only 20 to 25 years old. actually 30 to 35 years old, excuse me, BlackRock and Blackstone. So when it comes to it, it's very important to see what are your goals. If you want to scale a large company like that, you have to go the fund route and go to institutions, and that's what we're going. That's where I see the vision with the company and moving in that direction to a very large company is to go that route. So we have to create a fund. Benefits of a fund. The company lost 2 deals, 2 funds. Why? Because the funds came in and they said, we're paying cash. And I'm like, well, I'm syndicating the property. And the seller's like, well, they're paying cash. So that right there, we lost out. When you can show a proof of funds of $40-50 million of the whole asset, the seller has that secured feeling in their self with selecting a fund. The fund can then pay cash for the asset, hold the asset if they want with cash. If not, they can refinance, or they can just sell that asset to another asset and then get their funds out and then keep multiplying it. So it's all different. So having that, it's very beneficial when it comes to a fund. The scalability of a fund's extremely high. And when connecting with institutional investors, it's very different from the retail investors. And when I mean retail, I mean your accredited investors that are going to invest 50 to $1 million. When it comes to a fund, it's definitely different. You're having investors write 10, 20, $100 million checks.
Wow. That's awesome. Now, Chris, related question there, right? In a syndication, obviously, as a general partner, you are syndicating large part of the deal and you're owning a small share as well, right? How does that play into a fund structure? Is it similar, or how some of the splits involved in that?
Yeah, I love that question. It's not similar on a per deal basis. It's similar in fact that the deal, like a per deal basis, you would use that just for the fund though. So how it works is that you'll hear it in the fund world, 2 and 20. So the difference is when you have a fund, you get paid 2% of as a management fee of the fund amount.
I see.
Annually for the life of the fund. So if you have $100 million fund, you would get paid 2% of that, which would be $2 million on an annual basis for the whole life of the fund to manage the fund.
I see.
You would then get paid 20%, because it's a 2 and 20% of the profits. So if you profit $100 million, you're going to get paid 20% of that. And then the rest goes back to the investors. But you will also have the promote. For example, you'll see anywhere from 6 to 9% annually preferred return to the investors. Anything above, you'll see an 80-20 split to a certain amount. Then you'll see a 70-30 split to a certain amount. You'll rarely see a 60-40. You may see it with depending on the fund and what the fund's targeting and all that. But because of the fund manager and the company making so much, you normally see anywhere from 70-30, 80-20 split when it comes to it. But it's very similar to a syndication, but it's over the fund.
At the fund level.
Yeah, at the fund level. And a per deal basis, it's just, is it cash flowing enough? Can we hit the IRR to pay the investors the 8% annually of the whole fund amount?
Interesting. Great tips there. Now, Chrish, you are a great proponent of affirmations, and always you're purposeful about having notes placed and things like that. And can you maybe give us a sense of what are your morning routines? How are you setting goals and sort of dividing your time on different activities and stuff?
Yes, and we chatted about this before. Time management's everything.
Sure.
I wake up, my alarm goes off at 5 a.m. Now I do hit snooze. I'm honest. I do hit snooze. I got a newborn, and having a newborn, you're waking up throughout the middle of the night.
Sure.
So I do hit snooze a couple times, but my body naturally, even on the weekends, if I don't set an alarm, will wake me up before 6:30. It's just
That's
natural.
awesome. Mm-hmm.
I have it embedded in my mindset that I will wake up naturally before 6:30, but I like to wake up at 5. So when it comes to my morning routine, I meditate in the morning and in the evening. I meditate in the shower. Some people meditate just by themselves. They listen to music. I meditate in the shower because the sound of the water hitting the ground for some reason just soothes me. It puts me in a different mindset. And I meditate anywhere from 10 to 20 minutes. And I just think about business. I think about life, think about family. I think about the goals that we're having. I think about the current goals for that day, 5-year, 10-year. I think about all of it. It just all runs through my mind. And I think about what I'm going to accomplish for that day. I then wake up, have a cup of coffee. I love coffee. I drink anywhere from 3 to 5 cups a day. And then from there, I like to get some reading in on a book. If it's just, a couple pages, I like to do that. And then I'll hop into checking emails. After that, I start reading articles. I read a lot during the day. I know Warren Buffett reads like 4 hours a day, but I read a lot during the day with articles when it comes to the book and analyzing everything. It's very important to read and to understand and to form an opinion about what's going on. Even if it's not in your career. Like I said earlier, I look at the stock market. I check it. I want to know what's going on in the stock market, because if stock market's tanking, that may affect interest rates, which then affects me. Or not me, but affects the company. So I watch all that very closely, watch, what's going on with COVID, answer emails. I like to get a lot of the important issues done late morning to early afternoon. And then after that, making sure our system's in place, making sure I'm gaining more knowledge on the fund aspect, reaching out to investors, large institutional investors, connecting with them, building relationships throughout the day, making sure that marketing when it comes to social media or private Facebook group, making sure all that is getting poured with valuable content to everyone so they are soaking up the content. So yeah, I do that. And then when I start to wind down, like I said earlier, or before this, is that I have to work a minimum 12 hours a day. That's just, it's programmed. I get grouchy when I don't. But towards the end of the day, I like to go ahead and just recap what I did that day, what I do to be productive instead of busy, the systems that we had in place, and then I go ahead and spend some family time. Once the kids are knocked out, I start to read a book, and I go to bed around 12, sometimes 1 o'clock.
That's awesome. That's awesome. And I think you said it very right. I think being productive versus just being busy, just for the heck of it, sometimes can, your day and all the minutia that comes with it, right? I mean, can pretty much suck you wherever, but, being purposeful and being focusing on productivity is all that matters. So it's been great, Chrish. I totally appreciate everything you shared.
Yeah, thank you for having me.
Sure, absolutely. Please share with our listeners how they can find you and learn more about your company.
Yeah, you can find me directly on our website, qccapitalgroup.com. We do have a closed Facebook group called the Mindful Multifamily Network, where you can network alongside myself. That's where I pour great, valuable content in there about what's going on in the real estate industry and just in the industry itself, commercial industry itself. So that's where you can find me. That's where you can network with me.
Awesome. I think I have to make a point to be a member of your group now, actually.
Yes, please do.
Absolutely. So thank you for coming on.
Yes, thank you for having me.
Absolutely. Viewers and listeners of the podcast can also, reach us at premiumcashflow.com, where we have experts like Chrish all the time. If you're interested with any of the investment opportunities, kindly register with us. We can jump on a short phone call and understand what your goals are, and we can see if there's any opportunities we can help you with. So it's been great, Chrish. Thank you for coming on, and I am definitely looking forward to your future and having you on another edition of podcast as well. So thank you for coming on.
Yes, likewise. Thank you for having me.
Sure.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.